During the month of September, economic indicators have confirmed the sluggish state of the global economy, especially global industry. In Europe, the economy will have probably contracted again in the third quarter. In the US, the economy is growing at a pedestrian pace, 1.5 to 2%, while in China, the leadership is confronted with a deceleration in economic activity. In addition, global corporate earnings are under pressure, as evidenced by negative guidance from companies such as Daimler-Benz, FedEx, or Intel. While we should not dismiss this negative news flow lightly, we believe that the true action is elsewhere, i.e. with central banks. The ECB has confirmed its commitment to purchase short-term government bonds of Italy and Spain in unlimited quantity, provided these countries ask for support and agree with a set of conditions. By doing that, the ECB has practically removed the risk of a euro collapse. On the other side of the Atlantic, the Fed has expressed its open-end commitment to purchase long-term securities, understand mortgage-backed securities or treasuries, until the employment situation materially improves. In addition, zero interest rates will be maintained at least until mid-2015, and policy accommodation will remain in place a considerable time after the economic recovery strengthens. We believe this is truly economic history, as both the Fed and the ECB enter uncharted territory. What does it mean for markets? We believe that these policies will force cash-rich investors to put their money at work, with positive consequences for asset markets. Prime beneficiaries are credit markets, in particular high yield and emerging debt, which should remain well-oriented. During September, we have added to our exposure to emerging debt, local emerging debt, as we expect currencies of emerging markets to benefit from quantitative easing. With respect to equities, the benefit of quantitative easing is less obvious. Why? Because earnings are under pressure and visibility is low. However, we have selectively increased our equity exposure by focusing on two themes. First, US banks. Second, smart resources. US banks are well capitalized, contrary to European banks, and they should increasingly benefit from the recovery in the US housing market. With respect to commodities, in theory, they should benefit from quantitative easing, but we remain pretty cautious, and we prefer to invest via companies that benefit from increased investments in exploiting, accessing, and substituting commodities. We call this theme smart resources. It goes without saying that these policies from central banks, at the end of the day, increase the risk of inflation down the road significantly. Gold remains the clearest beneficiary of such policies, and this is the reason why we keep our strategic exposure to gold.